1971. They could point to 1 year and one date that they can kind of emphasize, or kind of similar things with the Great Depression. I think this period is more punctuated by multiple events. I mean, obviously, this decade kind of kicked off with a bang with the pandemic lockdowns, then the massive fiscal stimulus, and then like military engagements, kind of these big conflicts, and now rather major attempts at kind of fixing global trade and realigning that. So I think this will be seen as, especially if historians really dig into stuff, an acceleration of things that were already underway. And so there's already been, back in the 2010s, a very gradual shift east and a very gradual change in, for example, neutral reserve assets in central bank holdings, reliance on the treasury, security as a core holding. These things are already kind of gradually shifting. And this decade kind of kicked everything into high gear and brought it up to the mainstream and brought it up to kind of the main event. That's probably how I think this decade, at least so far, will be looked at. I think what incited it is cumulative effects. So there's not one thing that incited it. It's the system itself incited it, because the system itself was imbalanced. And so a way to put that is to say these trade deficits have been in place for decades. And 1 or 2 or even 5 years of trade deficits are not really a giant deal. But 3 decades, 4 decades, that becomes a really big deal of just consistent trade deficits from the United States. And the way that I've characterized this before is that it's directly tied to the current structure of the global reserve system, which is to say that there's all this foreign demand for dollars because it's the global reserve currency that's used for things outside the United States. It's used for cross-border funding. It's used as a reserve asset. It's used as one side of 90% of foreign exchange trading pairs. It's used for international contract unit of accounts for the most part. So there's all this kind of excess demand for it. And what that does, that overvalues the dollar on a trade-weighted basis, which gives Americans really strong import power, but then gives manufacturers and other low-margin exporters in the U.S. basically a disadvantage. It's more expensive to manufacture there, let alone compared to developing countries, but even compared to other developed peers in Japan and parts of Europe and those places. Another way of looking at it is that the whole world needs dollars if it's going to be the global reserve currency. And then the question is, well, how do they get dollars? How do they have trillions of dollars floating around the world outside the U.S. to be the global reserve currency? And the answer is trade deficits, structural trade deficits. So by overvaluing the dollar, it basically spills open dollars to the rest of the world. And so the U.S. gets all these advantages from being the issuer of the global reserve currency, but then some parts of the U.S. get the disadvantages. It gets a hollowed out industrial base. And this builds up kind of resentment for years and decades. I mean, basically, we saw a literal movement of wealth from the Midwest industrial zone in the U.S. toward the coastal cities that basically issue securities and benefit from that recycled wealth. So we're basically shipping out our industrial base and having it come back into our financial markets. And that over time builds up a sense that something's wrong, something's imbalanced. And so over time, the trade deficit is like a minor political issue. It's not really touched upon. Then, for example, in Trump's first term, it was like a minor issue, like he brought it up. He's long been focused on that topic, but he brought it up, and there's kind of a backseat compared to other things in that administration. But now in his second administration, it's kind of front and center, and it's a main political event now. And I would say this is because of accumulated issues. In a similar way, when the U.S. went off the gold standard, people think of it as an event, and it's easy to point to obviously one specific day and one specific year. But one thing I've emphasized is that problem was building throughout the 60s. So 1971 represented a breakage and an acceleration of a problem that was already occurring, which was that there was way more dollars being created compared to how much gold reserves the U.S. had. So it just you could kind of graph it and see it kind of slowly getting unbacked until it kind of broke all at once from a political decision. And while this is not quite that compressed, it's not like one event. This is a result of accumulated issues. They're now kind of front and center all of a sudden. Well, I think there are multiple strategies. I mean, they have more than just the trade situation going on. They have the attempt at fiscal consolidation, DOGE. I would say that so far that's going poorly in terms of the fact that deficits, federal spending is higher so far in the first 4 months of the year than prior 4 months and most other 4-month periods outside of the main pandemic stimulus years like 2020, 2021. So I'd say that's not going well. The part that they are making more waves on is the trade front, and that's far from over. So that's yet to be kind of fully written, I would say. And I think the best playbook to look at is Stephen Myron. He is Trump's chairman of his Council of Economic Advisors. And he wrote a paper back in November 2024, so right after Trump was elected, and he had been working on it obviously before then. And he is PhD in economics from Harvard, a trained professional that studies this. And he kind of laid out like the problem, like what I just described about the dollar being the global reserve currency and therefore having a negative effect on U.S. Ability to export things and our overall trade balance and industrialization. So he highlights that issue, and then he kind of analyzes a different way to go about fixing that. He looks at tariffs as an option. He looks at ironically putting a tax on U.S. financial assets or a fee on U.S. financial assets to discourage excessive reserve accumulation of dollar-based assets, which you wouldn't see many politicians talking about, saying we want the world to own less of our stuff because it's overvaluing our dollar. That's something he brought up in the paper, and he kind of tackled both sides of that, as well as like the idea of multilateral currency accords, something like the Plaza Accord of the 1980s. This would be a Mar-a-Lago Accord if it were to occur, because it's usually named after the place or the hotel that the agreement takes place at. Maybe the Geneva Accord, we'll see. And he kind of goes all those different solutions. And I think the challenge is that because it took decades to build up, it inherently takes at least years to really start to meaningfully change the course of something like that. So I would describe the playbook as interesting but flawed, maybe overestimating the U.S.'s negotiating position, and that I would describe the execution so far as rushed, and therefore more disruptive than it had to be, and kind of self-defeating in the sense that the levels of initial tariffs that were put on the U.S. were as harmful to the U.S. as to China and elsewhere, meaning that the U.S. had to kind of negotiate against itself in some ways. But this is still far from written yet. I mean, even in the past 48 hours, there's news about pausing some of the tariffs between the U.S. and China, making progress on that. So we'll see how that goes. But I think that, again, this is a acceleration moment. It's not a single time where, like, say, we see trade totally reverse, trade deficits close. This is more like the first serious attempt at picking away at a very strong network effect and maybe starting to gradually change its direction. So in general, fiat currency systems are like musical chairs in the sense, and for people that, most people familiar with that game, but basically it's like a children's game where you play music. There's, say, 10 kids walking around 9 chairs, and you stop the music, and they all have to scramble for seats, and 9 of them will get seats, and one unlucky kid won't get a seat. Then you remove it. That kid's like kicked out of the next round. You take a chair out, so then there's 9 kids and 8 chairs, and you keep going until there's 1 kid left. And the whole point of that is that the system only works while it's moving, right? As soon as it kind of stops, it doesn't work well. If you had a low debt equity-based system, it could mostly stop, and it wouldn't be great, but it wouldn't like completely implode on itself. It's not a house of cards. It's like a house of bricks. Whereas the current system is like a house of cards in the sense that there's far more liabilities for every base unit, which is like a game of chairs where there's like 20 kids and 1 chair instead of like 10 kids and 9 chairs, right? So the ratio is dangerous. And what that basically says is that, so there's, in the U.S., we have $100 trillion owed in dollars, so liabilities of dollars, and yet there's about $6 trillion in base dollars. And so you have a very high leverage ratio. And then outside of the U.S., there's nearly another 20 trillion in dollar liabilities, mostly not even owed to the U.S., owed between other countries. And there's only so many base dollars floating around outside the U.S. or ways to access base dollars in the U.S. And so this is a system that is kind of built to, it runs into issues, and then they inevitably print more dollars whenever there's a major issue, because they don't want this like $120 trillion debt pile collapsing down towards 6. We saw that attempted at the great global financial crisis back in 2008, 2009. Instead of letting that go down, they printed. In fact, if you look at that 100 trillion I referenced of domestic debt, if you look at like the 70-year history of that nominally went up every single year, with one brief exception for about 18 months in 2008, 2009. It was the only time it ever didn't go up, and it went down like 1%. And then they pulled out the printing bazooka, because you can't let that kind of Ponzi collapse at once, is how they view it. And the point is, although that's been somewhat deleveraged compared to 2008, 2009, just because of the sheer amount of base money creation since then, it's still highly levered. And then where this impacts trade is basically because the U.S. has run decades of trade surpluses with the U.S., deficits for us, surpluses for them. They've accumulated tens of trillions of dollars of U.S. assets.
So you meant with China or the U.S.? Because you said deficit with the U.S.
Yeah, so deficits from the U.S. perspective. Surpluses to the rest of the world, including China, but not just China, Taiwan, Japan, Germany for long periods of time, multiple other countries, Switzerland. They've accumulated collectively massive surpluses, and then they generally reinvest them in U.S. assets. They own U.S. stocks, something like 25% of our stock market. They own corporate credit. They own treasury debt. They own all these assets. And if they're ever short on dollars for their liabilities, especially these creditor nations, they've got this big war chest of U.S. assets that they can sell and kind of break U.S. capital markets to try to get their hands on dollars because there's so many claims for dollars compared to base dollars. So people describe it as dumping treasuries. I would say trimming treasuries. And it actually goes back prior to Trump's first term. It goes all the way back to somewhere around 2013, 2014. And that was when they announced the Belt and Road Initiative. They literally announced that accumulating treasuries is less than their interest now. And they also announced Belt and Road Initiative, which is basically using funding to basically develop a lot of their trading partners in some ways, infrastructure, commodity deposits, supply chains, things like that. And there's been a little bit of recycling by some estimates where there's less on the Chinese balance sheet, but then there's more in other foreign balance sheets that might be owned by China. So a little bit of kind of shell games going on. But even when you kind of include the higher estimates for that, it doesn't really make up for the downward trajectory that we've seen in Chinese treasury holdings. And another way I'd put it is that not accumulating is actually kind of the same as dumping because ongoing inflation happens, ongoing debt issuance happens. And for example, if you look at the past 10, 15 years, the percentage of the treasury market owned by foreigners has been going down because they've been collectively going up very slowly compared to U.S. issuance. So there has been somewhat of a repudiation of U.S. debt. It's not like a shock at all selling. It's just kind of silently not buying like they used to be. And China's been one of the bigger kind of linchpins in that because they were a huge accumulator in the 2000s decade. And then once they got into the early mid 2010s decade, that's no longer the case. As for the second part, I think that they're trying to have a mid-strength currency. So they don't want a particularly weak currency because they are trying to internationalize their currency. They're trying to make, they're the biggest trading partner with most countries in the world now. And they're basically trying to go to their trading partners and say, look, if you hold, Chinese currency bonds, those are money good. You can buy electronics with them. You can buy cars with them. You can buy all sorts of stuff with them. And we're not going to rapidly debase them, at least compared to something like the dollar and other debasing currencies. So I do think that they are trying to make a kind of a catalyst or a reason why you'd want to hold their bonds rather than just hold treasuries. Not because they want to displace the treasury. They don't want the problems I mentioned of like Triffin dilemma and structural trade deficits to support it. But with their own major trading partners, they do want to internationalize it in the sense that they want to be able to buy energy in their own currency. They want to be able to trade with their own currency with their biggest trading partners. And that basically means making the currency solid enough. Now, they don't want the currency to be so overvalued that it hurts their export business. But they're already very geared toward exports. So I think they're basically trying to maintain a rather balanced currency compared to the dollar. Not too high, not too low, kind of Goldilocks, just right. I think that's their approach. And yeah, if they ever gets too strong, one of their options is reserve accumulation. And if it gets too weak, I mean, that's why they use capital controls. They can sell reserves to buy back their currency. They have these kind of different levers they can pull to either weaken it a bit or strengthen it a bit over time.